The Rebel Capitalist Show. We've got Joseph Wang in the house, who just came out with an amazing blog post, and we're going to dive into this. Let's go ahead and tell people where we're going. Maybe they can follow along on their computer. We're at fedguy.com. So go to fedguy.com, hit home, and then the blog post called Inflationary Hikes, November 1st. So I think the first paragraph here, you're kind of outlining your ideas. Do you want to summarize that, Joseph?
Sure, sure. So, generally when people think about rate hikes, they think that it tamps down on inflation, right? And
Right.
there's mechanisms in the banking system how that would work in the past. But the thing is, I think there's been a structural change in how the banking system operates, such that when you have hikes now, it might not work as well. In fact, it may even be inflationary. And I
Mm.
think the way to think about that would be to realize that, and as you've noted many times, George, so banks are creators of credit, right? They create money. So one of the ways that you can think about inflation is that when banks create a lot of money, when there's a lot of credit creation, then there's more economic activity, and that's upward pressure for inflation. So in the past, the way that banks would work would be, let's say they would borrow short in the funding markets, right, the money markets, and they would have longer term assets.
Yeah, so
And
let's go. This is prior,
okay,
just to explain, this is prior to the GFC. Uh,
yes, exactly,
yeah, what we had the Fed funds rate would kind of determine the interbank lending overnight. So if there was a bank that did a loan for $1 billion, and that was a new dollar denominated liability they created. Let's say they had to transfer that liability to another bank. They needed an asset to back that up. So they'd have to transfer bank reserves that's a liability of the Fed. If they didn't have those bank reserves, they would have to borrow them. So they would have to borrow those from another bank, and then hopefully the loan was a higher interest rate than the
right.
amount on the bank reserves they have to borrow. They pocket the spread.
Exactly, exactly. So banks actually did not really care what level of interest there was because, like you just mentioned, they pocket a spread. So when the Fed funds rate goes high, when the Fed hikes rates, for example, then they just kind of pass on that hike to the borrower, and even though they just pocket that spread, so they don't really care. Back then, when the Fed would raise rates, for example, then the bank would pass that on plus the spread to the end borrower. And obviously, when rates are higher, there's probably less demand for credit, right? So when you raise rates, you dampen the amount of credit creation in the bank done by the banking system, and that kind of slows the economy down, right? But there's a structural change in how the banking system works now, and that banks don't really use borrow in money markets. They don't borrow in the federal funds market anymore. They're basically completely funded by retail deposits. Now, retail deposits are basically interest rate insensitive. So even if the Fed hikes rates to 2, 3, 4%, your typical retail depositor doesn't care. And so that means that rates are still zero for them. QE creates enormous amounts of deposits. That you can go to Fred, you can see that chart. And
Yeah.
in the article, we'll also see specifically the best kind of deposits. Retail deposits have just surged in the past
Right.
2 years. Um,
Right.
so now when you hike rates, then a bank actually receives more interest income, but its liabilities, its funding costs don't change. So
Hmm.
with every hike, banks are actually encouraged to create more credit, and that was not the case in the past. So let's say if the Fed hiked 4% back pre-GFC, the bank would not really care because they make that same spread. But today, now that's with every hike, they're making a wider spread, and that encourages more credit creation, and more credit creation, more loans, lower standards. That's obviously inflationary. So that's kind of this weird, I guess, pro-cyclical loop that we're in. And
Yeah.
that's just one channel. And the other channel was obviously the one that impacts us more directly, and that's our deposit rates. So another way you can think about um, rate hikes tamping down on economic activity is that everyone has higher interest rates on their checking accounts, right? So they're more reluctant to spend on the margins. If you were receiving, let's say, 2% in your bank checking account, maybe you would be slightly less likely to spend that money.
Mm.
So back pre-GFC, when banks were funding themselves in money markets, they were competing for these deposits. And but now that's totally different. And as you just mentioned, George, QE created tremendous amounts of deposits. Now the banks, they don't even have to compete for deposits anymore. So no matter, well, I won't say no matter, but even if the Fed raises rates significantly, we're still probably going to get 0% on our checking account. So that channel of raising the opportunity cost of money for retail people like me, that's not going to be there. And so
Mm.
that's another way that this mechanism is kind of broken. But that's kind of like a high level view. And I guess if we walk through the piece with some charts, it'll kind of come together.
Yeah, let's do that before or at least I scroll down. I'm right at the marginal cost to marginal return. I want to hopefully understand the uh, your idea that that higher interest rates would increase or potentially increase bank lending. So the way I see that is, and we didn't talk about IOER or IOR. That's
Yes, exactly
because
right.
what we've moved from is this environment where we've got the overnight rate to where people are paying for money, but now the Fed is paying them to park
Exactly.
money, to keep park those bank reserves at the Fed. If you want to look at it, the bank reserves denominated in dollars, and therefore,
Yes.
if they are getting paid, let's say 1%, then that is profit that's going to the bank. If they are paid, let's take it to an extreme. They go from 1% to being paid 10% on the $4 trillion worth of bank reserves that are parked at the Fed roughly right now. That would mean they are making a lot more profit. Well,
For
where
doing nothing, for doing
for doing
nothing. And
absolutely nothing,
that,
right?
yeah.
So then where does that profit come from? Well, the Fed would just create those bank reserves out of thin air, and therefore the amount of bank reserves that they would have parked at the Fed would increase dramatically. And if the amount of bank reserves that they have on their balance sheet, the commercial banks, if the amount of bank reserves they have as assets on their balance sheet increases massively, then theoretically their balance sheet capacity increases. So they're able to issue more loans because they've got more reserves to back them up. Is that kind of the logic?
So I think that I think banks are motivated in part by how much money they make from creating a loan, right? So there's that channel, the IOER channel. That's definitely right. So every time the Fed raises IOER, that's basically more money going to the
Right,
that's more profits to the banks.
right,
But
right.
in terms of actually creating credit, though, it encourages banks to create more credit because they make larger spreads. Their funding costs are stuck at zero because of the retail funding, retail deposits that are flooded the system. But their
Mm,
lending rates keep increasing with every rate hike. And like you mentioned, so in this new regime, the way that rates work, though, instead of controlling the funding costs of banks, they actually controls the asset returns of banks. So that's
right,
IOR. So
right, right, right.
basically, a bank, instead of when it wants to make a loan, for example, one of the things that it would think about is, what if I just leave this cash at the Fed?
Mm.
I earn, let's say, 1% IOR. I won't have to do anything, right? So the loans that it makes will have to be greater than
Yeah, I was just
than
going to
that
mention that. So
1%.
it doesn't mean that people's mortgages will stay the same if their interest rate on their bank deposits stay the same, because that mortgage rate would have to exceed the rate of IOR, or else they're not going to do the loan in the first place.
Yeah, yeah, that's right. That's right. And usually, when you have like a mortgage, it's 30 years, so usually it's upward upward sloping term structure. So it's usually higher.
Yeah. Okay, cool. So I think I'm definitely on the same page. So now I'm going down to marginal cost to marginal return. So in practice, implementation of monetary policy through banks has changed from adjusting the marginal cost of funding to adjusting the marginal return on assets. So this is exactly what we were talking about
Exactly right.
before.
And you can
Yeah.
see that just revolution in that chart here. So before the
Okay.
GFC, let's say banks were funding maybe 30, 40% of their liabilities in rate sensitive money markets, right? So these are
Mhm.
liabilities whose interest rates follow very closely the Fed funds rate. So
Right.
if the Fed were to hike rates, then that 30, 40% of money market liabilities, it would also adjust upwards with it. Now that's completely changed today when we can see maybe 10% of their liabilities are these wholesale liabilities.
Right.
And the part of that is by design. So during the great financial crisis, um, so one of the ways you can think about the GFC was that it was kind of a giant bank run, right? So a lot of banks were borrowing, let's say 3 months, 6 months in term, and taking that money and investing in assets that matured in several years.
Mm,
So there's that maturity mismatch. So when the Fed was hiking rates then, or maybe, no, not necessarily hiking rates. So if for whatever reason, the people who are lending them 3 month or 6 month money did not want to continue lending them, then what they would have to do is they would have to sell their assets to repay
yeah.
those short-term loans, right?
Yeah. Yeah.
When everyone does that, there's it cascades into avalanche of selling,
Yeah.
asset prices go lower, more lenders get skittish, more people withdraw loans, and so it
Especially when you
becomes
have
a
mark to market accounting.
yeah,
And even if
yeah.
you're not selling, your balance sheet's taking a massive hit.
Yes, exactly. And lenders who are lending them like 3 months or 6 months see that, and then they panic, and then they withdraw, and then that means more people are losing access to funding. That means more fire sales. And so you
Mhm.
have basically this a standard bank run, and that's what happened during the GFC. And in order to prevent that, uh, there's this new set of regulations. It's called Basel III,
Right.
and so it raises the costs of regular costs to banks who fund themselves more in the money markets. So it encourages banks to not do that. It encourages banks to either borrow, let's say, liabilities that mature for a year or more, or to have retail deposits. And that's part of the shift you see here. You have a whole bunch of banks just kind of consciously changing their funding profile so that they're not borrowing short-term money anymore, but they have a very stable funding base that won't run when things when the market craters.
How do you think QT would see if they so what they'd have to do is they'd have to reduce the amount of QE they're doing down to 0, and
Yes.
then they could go ahead and raise interest rates, and
So
then they could do QT. I'm just thinking if they do QT, then that would really reverse what we're talking about.
yes, so QT would shrink the amount of deposits in the banking system. It takes out
Yeah.
reserves, but reserves are just one side of the balance sheet. The other side is usually a deposit. But this is kind of getting in the weeds a little bit, but deposits come in different types of qualities. Usually when the QT is kind of shrinking, it's kind of the low quality deposit that, let's say it's a deposit held by a hedge fund manager that
Mm,
it does not have good regulatory treatment anyway. So it won't matter that much.